Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 321st VideoCast podcast for the week ending December 11th, 2025. We got a lot of great stuff to cover today, and a very, very special guest interview, which you are going to love. The CEO of one of our big holdings. Super excited for that. But as always, family first. Dug up one of these videos, pictures of Mimi and Annabelle. I think this was from 6 years ago. Time flies. Then we got, this is from this weekend, walking around by the new place, which is pretty exciting. That was from last week, Thursday, when I was still in New York in the green room. I got my driver back yesterday. I've been really struggling with it the last 3 weeks, and my buddies over at Urban Golf, shout out to Matt and Chris, got me back on track. Those of you who are golfers will know that this is a pretty good position for ball striking, and I was hitting the hell out of it yesterday. I'm super excited. And then this is a reindeer. We did the Christmas walk locally here, and they actually had a real reindeer in 65-degree weather. I don't know how good that is for the reindeer, but there's Annabelle in the background. I've actually never seen a reindeer in person, so that was pretty exciting. Then had the pleasure to join the great Stu Varney on Fox Business, and you see Lauren Simonetti there, who's fantastic, and want to thank Peyton Jennings for having me on in studio. We're going to listen in here.
The producers are listening. Bing Crosby is the voice of Christmas, in my personal opinion. Certainly for my generation, you go back half a century and you get Bing Crosby. That's beautiful, though, isn't it? That's Christmas music.
That's right.
Isn't that right, Tom Hayes?
I agree.
And you're going to support me on this, aren't you?
100%.
Lauren's not so sure.
No, I love it. I was just thinking these days kids like the pop Christmas music.
Yeah, well, these kids do, yeah. Am I a kid, he said?
No, you're a traditionalist.
That is true.
Vintage.
Nicely done, Lauren. Nicely done. And good morning, everyone. It's 10 o'clock. A little red for the Dow. It's off 40 points. Nasdaq's down 32. There's not that much price change on the downside thus far. Tom Hayes joins me. He's looking at the market for us. Everybody and his brother who comes on this program says, yeah, we're going to get a year-end rally. Are you saying the same thing?
Only
Yes.
the Fed could screw this up with
Really?
a 90% chance of a cut next week. If they surprise the market with a hold, that would be the only thing that could cause a year-end weakness. When the stock market is up 10% through October, on average, the December rally is not the normal 1.2%. It's 2% or greater. And that usually starts the 14th or 15th of the month, and it is usually dominated by small cap stocks. Small caps have the strongest period of outperformance from December 15th through March, so that's where you're going to get the biggest bang for your buck.
So I should invest in the Russell 2000?
Russell 2000, December 14th or 15th. Just get through that Fed meeting. Make sure they're on board. As long as they're on board, we're going to rally. We got earnings growth in the S&P. Quantitative tightening stopped in December. 316 cuts across global central banks this year. We are awash in liquidity. We just need that final piece next week.
Just watch out for the PCE inflation report tomorrow morning.
That's right.
That could upset the apple cart.
That's right.
It could.
Yep.
We shall see.
For sure.
But you don't think it will?
I don't think it will. I think for the Fed to back up after the market is expecting a 90% odds, that would be very, very risky for Powell. But he's done it before, December 2018. So until it's done, it's not done.
Until it's done, it's not done. I got it. Tom Hayes, you're all right. Thanks very much indeed. Still ahead. Thomas, what do you think of the Trump accounts?
I love them. There's something called the rule of 72. Okay, you take the rate of return, which on an index fund would be about 10% a year, divide 72, which means your money doubles every 7.2 years. So if you start with 1,000, by the time you're 18, you basically have 16,000. But if you get granddad, grandma to throw in a little bit, and you start with 10,000, you're starting college with 160,000. So the 1 grows to 2, grows to 4, grows to 8, etc. And if you hold that money till you're 40, exactly what JC was talking about, you wind up with a couple mil.
I shall try to remember that.
Yeah.
Tom, good stuff. Thank you very much indeed. On the markets, I see 24 points up for the Dow, virtually no change for the S&P and for the Nasdaq. Okay, Tom's got his special stock picks, and he leads off with Pfizer.
Yep. As we always say, Stu, when the downside is protected, the upside takes care of itself. This appears to be a boring stock, but they just did the Metsera deal, which is a once-a-month GLP, both that you can inject and will eventually become oral. They bought Seagen. They've got 4 new oncology drugs, but most importantly, they cut $7.2 billion in costs. Margins are increasing. Revenues are increasing. It's trading at 8 times forward, and you get a 7% dividend yield while you wait.
Okay, I like the 7% dividend.
This is a sleepy stock that's going to surprise people over the next couple of years and go up a lot more because healthcare is in the gutter and it's coming out like a phoenix from the ashes.
Okay. I'll take the 7% dividend. All right. Okay. PayPal. You got 30 seconds to give me PayPal.
Okay. This reminds me of a company that we bought 2 years ago when no one wanted it, that was generating huge free cash flow. You couldn't give it away. It was called Alibaba. No one wanted to buy it. The thing took off. It's tripled off the bottom. PayPal is going to be a very similar situation, generating $6 to $7 billion a year of free cash flow. Alex Chris came from Intuit. He had a 38 bagger while he ran the small business unit at Intuit. Margins are increasing. Revenues are reaccelerating. No one is paying attention.
That's more than 30 seconds.
And this is going to be a great stock over the next 2 years.
The hand is down. You're done.
Pound the table. Confidence on that one.
Thanks. All right. Let's see what we got now. Look at Meta. Tom, this is for you. Look at that. 4% gain for Meta. Tell me more.
You know, Charlie Munger once said, I'm all for artificial intelligence because natural intelligence is so rare. Here's an example with Meta. The stock is up. The market likes it. They're cutting their spend on the metaverse, which was a flop. They're investing in AI. The market likes it. The stock's going to continue to follow the theme.
All right, Tom, thank you. Thank you, Lauren. And thank you, Tom Hayes, for being with me for the hour. Appreciate that.
And we're back. And then I had the pleasure to join David Asman, also on Varney & Co. Fox Business, thanks to Peyton Jennings, just yesterday before the Fed meeting. We'll listen in here.
Meanwhile, Thomas Hayes joins me now. Thomas, great to see you. The Fed, of course, is expected to cut about 0.25% today. There's, I think, a 90% chance that's going to happen. But the question is how Powell answers questions and whether or not he's going to cap any further rate cuts to some very strict limitations. What do you think the market's going to make of it?
Well, I think that's exactly right, David. We will get a cut today. The question is the rhetoric and, more importantly, the summary of economic projections. In September, the projections implied we would get a cut in December and then only one more cut in 2026. Market doesn't want to see that again. They want to see at least 2 cuts in 2026. So if there's no change in the summary of economic projections, the market might not be happy in the very short term. But have no fear, David, because Santa is here. The Santa Claus rally historically starts since 1950 on the 14th or 15th of December. The reason for that, David, is because of individual tax loss selling. So most individuals spend the first 2 weeks of December selling off their losers, the stocks that did not work for the year. And in this year, the stocks that did not work were defensive stocks, dividend payers like consumer staples, healthcare, the boring stocks, and dividend pairs, which, by the way, work extremely well in an easing cycle. So we've got a couple of those for you.
Well, and one of them is Papa John's. Why do you like it?
Papa John's, 4.5% dividend yield.
Nice.
New CEO came from Wendy's. He ran Wendy's from 2016 to 2024, had a 3-bagger when he was turning that around. Comp store sales are up 2%. They're refranchising 85 units, which is adding to free cash flow. They took guidance up, and everyone loves pizza. It's a no-brainer.
And by the way, as you were talking, it went from red into the green. It's now up 0.25%. Hormel is entering a phase of growth. Why is that?
Another dividend payer, the highest yield we've seen in a long time. They've been paying a dividend every single year since 1928, David. And for the last 60 years, it's been a dividend aristocrat, which means it raised the dividend every single year. So not only do you lock in a 5% dividend yield, but odds are it's going to go up every single year. They've got a whole suite that's right in line with the GLP-1 theme, high protein snacks, from the sausages to the Spam to the stew to the Planters peanuts to the Skippy, etc. This thing is now re-accelerating. Some of the tariffs on food have been rolled back. It's a strong, healthy dividend, and we think this defensive dividend payer is going to do well in a midterm election year, which tends to be volatile.
Tom Hayes, great information. Thank you so much for being here. Have a wonderful holiday. Let's get back to this survey that shows Donald.
And we're back. And now for the grand finale, we had the CEO of GXO Logistics on our podcast, one-on-one interview. Absolutely incredible interview. You're going to want to listen in here. Why? Because GXO is the embodiment of playing the AI beneficiaries that will have margin expansion and increased productivity as a result of utilizing the tool versus the hyperscalers whose CapEx is now higher than big oil, okay? CapEx as a percentage of operating cash flow, margin compression, they are the spenders, we are the beneficiaries, and GXO embodies that. Can't thank CEO Patrick Kelleher enough and Chairman Brad Jacobs for setting this up. We're going to listen in here and take good notes. Well, I'm Tom Hayes, Chairman and Managing Member of Great Hill Capital, and we have an extremely special guest on today on Hedge Fund Tips with Tom Hayes, the CEO of GXO Logistics, Mr. Patrick Kelleher. Patrick, thank you so much for coming on today.
Absolutely, Tom. Thank you for having me.
Well, everyone knows we talk about companies that we own. We've had a nice sized position in your company for some time. And let's get right down to the questions. That's just in full disclaimer. Before we dive into the business, I want to start with your background and your decision to join GXO. You bring more than 3 decades of global supply chain experience, and most recently as CEO of DHL Supply Chain North America, where you oversaw significant growth, operational improvements, and the rollout of advanced automation initiatives. Brad Jacobs, who we also own QXO, full disclosure, described you as a world-class operator with the experience to lead GXO through its next phase of growth. You've also mentioned that you've watched GXO, quote, with a lot of admiration and maybe even a little envy since the spinoff in 2021. From that vantage point, as a former competitor, what is it about GXO that made you want to join the company? And now that you're on the inside, what has stood out most, whether it's the technology, the culture, or the performance mindset that reinforces your conviction in the opportunity ahead?
Thanks, Tom. I'm thrilled to be at GXO. And as you shared, I have a 32-year career in supply chain. I majored in supply chain in college. I started with a company called GXO Logistics that was acquired by DHL in 2005, all the way back in 1992. And my entire supply chain career has been focused in the contract logistics industry, which is and continues to still be a massive industry, $500 billion in total addressable market.
Wow.
It is fragmented globally and it continues to grow. Throughout my career at DHL, I held a number of different roles, which I think gives me a great perspective on the industry, competing in the industry, and especially providing great services for customers. Most notably, probably the last 2 roles that I held at DHL, I was from 2017 to 2023, the Chief Development Officer globally for DHL Supply Chain, responsible for global sales, marketing, product development, our market verticals, and M&A during that period of time. And it gave me a great global perspective of the health of the market, where the market is especially dynamic and where the growth opportunities exist, and really was a great foundation for my new role at GXO. And as you say, I've watched GXO since 2021 in the spinoff. I think by GXO going public and really being the pure play contract logistics leader in the industry, one of the few, if only publicly traded, really, I think, put definition to the contract logistics market, created awareness within the market around the industry and the great potential that the industry has. When I got the call from Brad on the opportunity to lead, it was an easy decision for me. Having been in the industry for a long time, loving the industry, admiring GXO, I was especially excited about the opportunity to join a pure play contract logistics organization. I think that comes with agility, a very special dimension of customer focus in the services that we're providing. I love the speed of decision making, capital allocation decisions, investment and technology decisions that are being made. We are moving very fast. I love the agility and speed at which I'm able to move as a pure play public company in this space. Yeah. And as you say, I've watched GXO with envy and admiration since 2021 as well, and especially with GXO's position as a tech leader in the space. GXO has really been on the forefront of piloting robotics, automation, AI now, humanoids now. We have in our facility, which is really exciting, waking up every day working on that. And I think that coupled with the global scale that GXO has, the vertical expertise that has been built, especially through M&A over the last 4 years, it is a phenomenal platform for growth. And we're really focused on ushering in a new era of growth at GXO.
I love that. That's music to my ears, Patrick. I want to drill down on North America, which you made a clear priority on your inaugural earnings call after taking over as CEO. The U.S. business generated about $3.1 billion in revenue in 2024, roughly 26% of GXO's total. A small share of the $250 billion plus North American market, which speaks to the size of the opportunity we still have ahead. Having led DHL Supply Chain North America, this is a market you know extremely well, and you've already highlighted near-term opportunities to accelerate growth across the region. You've pointed to aerospace and defense, industrial, and life sciences key verticals for expansion. Brought in Michael Jacobs as president of the Americas and Asia Pacific and reallocated resources towards sales and marketing to strengthen the company's position. Could you speak to what you're doing differently in North America to compete and win new business, whether in terms of your go-to-market strategy or vertical focus to unlock more of that $250+ billion opportunity? And secondly, as you scale into higher value sectors like aerospace, defense, and life sciences, how should investors think about the impact on margins and mix compared with the more mature omni-channel retail business?
Sure, that's a great question, and I've been very clear that North America is a priority market for us. I think to put that into context, about 2/3 of our business globally is in the UK and Europe. That is the result of a really strong and successful M&A effort in those geographies. Yeah. GXO has doubled in size from a revenue perspective since the spinoff in 2021. And that has been on the back of a lot of M&A, particularly in those two theaters. Those M&A transactions brought with it great vertical expertise in technology, industrial, and aerospace, especially. And then most recently with the acquisition of Wincanton, brought great capabilities in the defense space. In looking at GXO, GXO has underdelivered from a growth perspective in North America in comparison to the market growth that we have seen in contract logistics and in comparison to competitive peers. So it is very clear that with all of the capabilities and competencies that we have, we need to focus more on North America as a key growth driver for us organically going forward. And so we've already taken big steps in positioning ourselves to really compete and win in North America. We've announced Michael Jacobs coming into the organization. He is leading North America and our Asia business. Michael's a 30-year veteran of the industry. He and I have worked together for 25+ years of that, with him as my customer, by the way. Wow. So he is coming from the customer side, most recently with Ferguson Enterprises, Keurig Green Mountain before that, and Toys R Us before that. So he's got phenomenal operating competencies. He understands what our customers are looking for in a contract logistics provider, and he's lining up his team to make sure that we're delivering against that every day. As you mentioned, from a market vertical perspective, we are putting additional emphasis on what I call the B2B verticals. That is aerospace, defense, life sciences, technology, and our industrial sector. About 70% of our business at GXO is associated with consumer-facing verticals. That is e-commerce, omnichannel, CPG, and bricks and mortar retail. And so we really want to seek some diversification in the size of our market verticals. We are already well positioned, especially because of the M&A completed, with the competencies, the talented people, and the capabilities in aerospace, defense, and the other B2B verticals to execute successfully for customers. And we're investing in the organic growth of those spaces. We're very focused on spinning up even further our digital marketing engine. We've already hired new salespeople, especially in the area of aerospace and defense, leaning on industry veterans to help us get in the right conversations for growth in that area. We're standing up an advisory board of former military veterans who are going to help us navigate the defense space and understand where we can best serve customers, deliver value based on the capabilities of GXO. And from that, we think we are so well positioned to win in North America. This on top of the also great work that we're doing from a technology perspective in the efforts around AI, our new GXO IQ solution, which is the path to our facilities for the deployment of AI. We think we're going to be very successful in North America, and that is really important to our organic growth and as well as margin expansion for the business.
Love it. Love it. Well, Patrick, I want to touch on an area that's often a challenge for transportation and logistics companies, but increasingly actually looks like a potential major tailwind for GXO, and that's tariffs and the growing reshoring trends that we're seeing as a result. At the time of the spin, GXO estimated the total addressable market of roughly $430 billion across North America and Europe, with about $300 billion of that spend still handled in-house. Whether it's manufacturing returning to the U.S. or companies bringing warehousing back to local markets to reduce fulfillment costs and complexity, these shifts seem like a real shot in the arm for the outsourcing trend. You've also mentioned increased customer interest in foreign trade zones, with GXO now operating more than 70 FTZ locations globally and exploring further expansion of that footprint, which feels like a real validation of that trend. Could you first speak to how tariffs and reshoring trends are influencing customer decisions around outsourcing, and what kind of tailwind you see that creating for GXO? How's the company positioning itself to capture that in-house spend as these shifts accelerate? And more broadly, how do you view the long-term opportunity these structural trends present as supply chains continue to localize and the outsourcing cycle gains momentum?
Starting with tariffs, tariffs are a catalyst for supply chain efficiency, and we're seeing that happen broadly across the business. And for the contract logistics industry, anytime you have economic disruption or what could be perceived as an economic headwind or change like a tariff coming in, it is an inspiration to drive towards more supply chain efficiency, and it creates a willingness on the part of our customers to make changes in their supply chain to capture those opportunities. I think in your reference to FTZ, we're operating about 70 around the world. That solution is becoming dramatically more interesting to customers. The price point at which it made sense to flow product through an FTZ was significantly higher last year than it is today. And now to where product of $20, $30 value, individual value, do have an ROI associated with FTZ and leveraging a strategy of deferring the tariff and duty payments for cash flow benefit. And I think it's really fascinating that these headwinds or perceived headwinds of things like tariffs can create supply chain change that really becomes permanent, and those efficiencies become permanent in the overall supply chain execution ecosystem. And so for our business, as customers are wrestling with how to address the nearshoring of manufacturing, the tariffs and so forth, that is all necessitating supply chain change. And that is good for the industry. That is great for GXO because we're really well positioned to respond to that. Additionally, from an industry perspective, and we're so well positioned as GXO, as the complexity of automation, robotics, AI, the technology stack and the technology ecosystem that is required to address increasing supply chain complexity is evolving, we are best positioned to service our customers in executing supply chain solutions versus the in-house solution of having to build the equivalent technology stack, technology ecosystem plugged into the tools of robotics, automation, and AI to enable the execution of complex supply chain solutions. And so we are really focused as GXO in investing in that ecosystem. We think it provides real competitive differentiation, not only from other contract logistics providers, but especially from the decisions that our customers are making every day of whether they should insource or outsource. And it is going to be increasingly difficult to build and replicate what GXO has in place, and is continuing to build around the systems, tools, and processes, and especially the people that execute those solutions on a daily basis.
Love it. Well, that's really helpful, Patrick. I want to shift gears. I want to talk about organic growth, which you've made clear is your top priority coming in and something you've said you really thrive on. At the height of the e-commerce boom, GXO was growing at high teens pace, even reaching 20%. Then came the abrupt rotation from goods to services and the resulting destock cycle, which led to a sharp slowdown with organic growth bottoming in Q4 2023. We saw that across many portfolio companies for us, and that was the clear inflection point. That quarter marked the inflection point, and since then, growth has steadily improved, with Q2 this year the strongest in more than 2 years, and full year guidance suggesting another step up heading into 2026. With that recovery firmly underway and nearly $700 million in incremental revenue already secured for next year, how do you view the organic growth potential of the business today? And as you think about what's driving the acceleration, whether volumes, pipeline conversion, or expansion into new verticals, where do you see the greatest opportunity to sustain the momentum and define what feels like a new era for GXO?
It is a new era of growth at GXO with the priority on organic growth. We are still going to embark on M&A. M&A will be very focused on the North America market and in the B2B industrial verticals that I talked about of aerospace, defense, technology, life sciences, and industrial. As you say, in 2021, GXO was enjoying organic growth of high teens, even as high as 20%. And this year we will deliver mid-single digit organic growth. We want to ramp back up to our full potential in that area. We haven't given 2026 guidance on that yet, but we will be at an investor day in 2026, and everyone should look forward to that. But it doesn't take away, the absence of the guidance doesn't take away from the belief that we have that we are capable of more with respect to organic growth and already putting actions in place to deliver against that. I mentioned that we're participating in a big market, over $500 million globally. And today we only hold about 3% market share in that, and the market continues to grow. Everything I've read suggests a 6 to 8% CAGR for the contract logistics industry through 2030, and we're well positioned to capture our fair share and beyond of that growth. In terms of the actions that we're taking, the organization has been very focused up until this point, and we are at an inflection point as GXO, as the organization has been very focused on M&A and digesting that M&A. That has positioned the scale and the capability and the competencies that we need in order to deliver organic growth. And it's really time that we accelerate that organic growth for the business. We're doing that through more robust digital marketing in terms of getting our name out there and connecting with customers, interested in outsourcing and also creating interest in outsourcing. We're adding to our sales team, and I mentioned we've been adding salespeople on the B2B verticals even since I joined 4 months ago. And we're going to be very focused on high growth markets like North America and high growth verticals where we are seeing a disproportionate level of growth in our pipeline on those B2B sectors. So with that, we expect that organic growth will ramp. I would add that we're going to focus in those areas, North America, especially the B2B market verticals, especially in 2026. 2027 brings the opportunity for us to continue to dig in on our current business in Asia, where we're really well positioned in Thailand, Malaysia, Singapore, a toe in the water in Australia. And that introduces a whole new TAM to our business in terms of organic growth that we can go after. We also have customers talking to us and interested in pulling us into the Middle East. And we think in 2027 beyond, we'll be ready for a focus and attention to that theater. That is another opportunity for TAM and our business, all while our teams continue to grow our presence in the consumer-facing sectors of e-commerce and retail and CPG, and the markets of the UKI and Europe, where we continue to see great growth opportunity. I would also say that a lot of what's happening in the world in terms of reshoring, particularly infrastructure investments in Europe and so forth, really plays well to the capabilities that we've acquired through M&A over the past years and those B2B sectors where we have really strong capabilities. So we believe the market's coming to us in that. That outsourcing makes a lot of sense for customers in that market, and we're well positioned to execute against that.
Love to hear, Patrick. You mentioned getting your fair share. I hope you get an unfair share because your execution is so superior. Moving on, Patrick, in your comments at the third quarter results, you highlighted driving margin structurally higher as a key focus area for you. I know you're currently integrating Wincanton, which should unlock some cost synergies for GXO, but can you talk through the levers that are at your disposal to drive margins structurally higher?
Sure. If organic growth is my first priority, then margin expansion is a really close second.
Okay.
With respect to Wincanton, we are on the path of capturing the M&A synergy opportunities there. We will achieve our goal of a $60 million run rate as we exit 2026. About 10 to 12 million of that has already been captured, and the actions in place to capture the balance. We are still seeing relatively flat volume, plus or minus 1 or 2% from our customers, and our growth plans and our margin expansion plans are not dependent on volume coming back from our customers, but rather more through two key levers, and that is organic growth, which I talked about, participation in the North American market, which is a healthy market from a profitability perspective, as well as driving our presence in the B2B verticals, which come with more complex supply chain solutions, higher risk in execution, and therefore higher reward and profitability of the solutions that we sell in those areas. So from a portfolio perspective on organic growth, we expect a benefit on margin expansion and driving towards that. The other is on operational execution and our operational excellence agenda. I recently announced that we would be hiring and have now identified an individual to be announced shortly as the Global Chief Operating Officer. That individual is focused on looking at our business through a global lens. Because I believe the level of M&A that the business has done over the last 4 years, the business at GXO has been run as regional silos, really not looking yet at the business from a global perspective and how we can leverage our scale in the best way possible. The new global COO is a big part of putting that global lens on the business in really two dimensions. One is from a labor productivity perspective, making sure that we've deployed the best tools to drive the best productivity and the best underlying labor costs, doing that in a consistent way around what I will call the GXO way, globally across our 1,200 plus operations. And we believe there's labor savings opportunities there where we can benefit from margin expansion. Our customers can benefit from lower cost. The second is around technology, and we continue to be a leader in automation and warehouse robotics, AI, now humanoids. We are driving towards making sure that we're working with the right partners, that the solutions that we're deploying deliver ROI, and accelerating the pace in which we're getting these solutions into the hands of our customers to create value for them and to drive margin expansion in our business. And then finally, from an SG&A perspective, we think we have the teams in place in order to be successful, and we continue to drive, particularly looking through a global lens. Where can we leverage our global scale around procurement as an example to make sure that we get the best leverage of our SG&A for margin expansion as we go forward? We are planning an investor day in 2026, a date to be announced, and we're going to share a lot of details on each of those pillars in terms of our path forward over the next 3 years.
Well, it's great to hear that, Patrick. And, you hear so much noise about AI is going to increase productivity and margins and humanoid robots. And honestly, the only company that I can see already doing it and already implementing this technology way ahead of the curve is GXO. So that's really, really promising. Switching gears to another value-added service that GXO offers, I'd love to touch on reverse logistics and the long-term opportunity in that space. In traditional brick and mortar retail, only about 1 in 10 items are typically returned, but that number jumps to nearly 1 in 3 for e-commerce. A lot of people don't know that. For retailers, outsourcing reverse logistics seems like a no-brainer. GXO has cited that roughly 96% of returns processed through its network are returned to stock, compared with an industry average of about 25% of items ending up in landfills. So not only is this an attractive opportunity from a cost-saving perspective for retailers, all you retailers listening into my call, you need to reach out to Patrick, but it's also a lucrative, higher margin segment for GXO, with these contracts carrying significantly higher margins and revenue multipliers compared to standard contracts without these services. Could you first speak to how large you think this opportunity could become as e-commerce continues to expand its share of the overall retail pie? Why do you think more omni-channel retailers haven't yet outsourced their reverse logistics, given the clear cost and operational benefits? And finally, how should investors think about the margin profile of these contracts and their role in driving a structurally higher margin base for GXO over time?
Sure. The third-party logistics market for reverse logistics is really exciting. I think total addressable market's now about $60 billion last I heard. It is a service that is embedded in what we do for customers today. Leveraging our process expertise, we've deployed AI in this area, by the way, as a medium to try and capture the highest value for return products for our customers as they look to either return product to stock or put those product out to the resale market. We acquired a really great business called Service Tech with the Clipper acquisition, in which we're actually doing repair of iPads, cell phones. I've seen expensive Italian coffee machines being repaired. And that's all a great way in terms of how we're increasing the margins for our customer of the resale of those products and the capture of the value of product that is being returned. And we, in turn, are being rewarded with good margins on the provision of those services. One of the things that really excites me about this space is the competencies that we have in the retail and e-commerce space, which we execute so well, have high application in the B2B space. And today we are managing cell phone returns at a very high scale. A lot of regulation in Europe is really driving customer interest in solutions for returns because of regulatory requirements that have to be met. And that is going to be a real catalyst for growth. And it's been fascinating to see in the data center work that we're doing, where we are performing services in support of the sustainment and maintenance of data centers. There is a lot of return product as a part of those services. And we are applying the same competencies that we have for the retailers into the B2B space to make sure that those companies are capturing the greatest value with product that is being returned. I also think that we're playing a great role in terms of being responsible in processing product returns, doing the right thing for the environment, making sure that product that is disposed in the right way, and that the value of product can be reclaimed even before product is disposed or destroyed, and especially driving towards product being preferenced to a resale market going forward, either as a new product going out or as a remanufactured or repaired product going out. So for us, the services around returns has such applicability to our customers. It creates real value for our customers in monetizing returns in a way that adds to their margins, and a great way for us to grow our business with that as an embedded service as a part of our forward distribution services as well.
That's great. One of the hallmarks of Brad Jacobs' playbook, and we have a lot of institutional investors that listen, and we also have a lot of ultra high net worth retail investors that listen. So those who don't know Brad Jacobs, all you need to know is he's one of the greatest wealth creators for shareholders in history between Waste Connection, United Rentals, and XPO. If you'd put $1 million with those investments, you made 300 million, 300x if you aggregate all three of them. So he knows how to generate value for owners. And he's the chairman of your company. He's been leveraging technology and automation in traditionally outdated industries to win share. GXO is a prime example of that, leading the industry in automation with over 40% of revenue from automated operations and more than 15,000 automated units and cobots already deployed across the network. We've long viewed GXO as one of the most underappreciated ways to play the broader automation and robotics theme. Where does GXO stand today relative to the rest of the industry? And how do you view automation as both a competitive differentiator and a key driver of scale? What are you seeing from customers in terms of interest and demand for automation within the sales pipeline? And lastly, as you continue moving toward more fully automated sites, how should investors think about that margin uplift, productivity improvements, and customer stickiness that come with greater automation? And just as a dovetail on GXO Direct, which gives mid-sized customers access to the same technology and automation investments that would typically be out of reach, how would you describe that value proposition, and how significant of an opportunity do you see for that platform as automation continues to scale across your customer base, Patrick?
Leadership starts at the top. GXO is a leader in technology, and I'm smiling based on your comments with Brad. Brad has always been a pioneer in technology. Technology features very high in all his businesses, and even for himself. When I'm interacting with Brad, he is a prolific user of AI on his phone.
Yeah.
He uses it in summarizing meetings that we've had, creating actions, doing research. It's amazing to see how he, as an individual, embraces new technology, plays with it, figures out how it can help him improve how he works every day. And I think that ethos makes its way throughout the GXO organization, and I think is a big part of why we are positioned in as a market leader in tech innovation. It has fascinated me for the 32 years that I've been in supply chain that the warehouse has somehow become a surprising driver of tech innovation and really the test bed for technological innovation going forward. So we continue to embrace technology, robotics, automation, AI, humanoids, all inclusive in that, as a key catalyst for how we create value within the supply chain and how we create value for our customers, and certainly underpins our aspirations for further margin expansion and organic growth. As a couple examples of that, GXO IQ is a new tool that we had announced and launched in the third quarter of this year. It's the first AI native operating system designed specifically for supply chains. We've done that in partnership with Google. It's built with AI integrated at the core. It's not layered on top or middleware, anything like that. And that is allowing our teams where we have deployed that to make millions of decisions in real time and orchestrate those decisions in really interesting ways. That is for us going to be the platform for how we deploy AI to our 1,200 operations And where we see good things happening from an AI perspective, that allows us to truly leverage our global scale around the deployment of that. And we have seen great success with AI in terms of labor planning, production planning, slotting, picking, and helping our operations be more efficient. We feel like that creates customer stickiness with having this ecosystem of technology that is integrated with proven ROI. And I think is going to inspire our customers to want to participate with us in journeys to deliver value in supply chain. In terms of customer stickiness, our contracts are longer when automation is employed. They're typically 10 years or longer compared to our average 5-year contract. Margins are higher in the operations where we have deployed automation and our technology ecosystem in a great way. And that really goes with the margin expansion opportunity to accelerate the pace in which we're getting that into the hands of our customers and doing that in a way that we and our customers can share in the value that is creating. And so we're really excited about the future that technology is bringing to us. And we're really going to harness that on the 2 priorities of organic growth and great operational execution margin expansion going forward.
Super funny little anecdote to your point with Brad. I met with him in person a couple months ago at the GXO offices, and pretty much the first thing he does in the conference room, he says to his phone, "Tell me who is Tom Hayes, Great Hill Capital, and tell me more about his podcast, Hedge Fund Tips with Tom Hayes." I'm like, uh-oh. And it just goes on and on. Fortunately, it was all positive. So the meeting lasted an hour and a half. But if he had said, we don't know who he is, he would have been like, security, have him out of here. But I saw him use it in real time. I was like, wow.
Yeah. Feel it coming from my performance review. Yes.
There you go. Well, staying with the technology theme, Patrick, a big part of our investment philosophy at Great Hill Capital has been focusing on the beneficiaries of AI, the everyday so-called boring companies quietly using AI to drive productivity and efficiency, rather than the hyperscalers, what we call the cost centers, the ones spending all the money building out the infrastructure. GXO is a perfect example. Earlier this year, you launched GXO IQ, the industry's first AI-powered cloud-native operating system for logistics, developed in partnership with Google Cloud. From pick path optimization that evaluates billions of variables per run to proactive replenishment that accounts for labor, inventory, and even weather, early pilots have shown a 22% productivity improvement across 30 sites. For those less familiar, could you walk us through what GXO IQ does and how you see it scaling across your network and customer base? What kind of feedback are you hearing from customers so far? And commercially, how do you view the long-term opportunity as customers adopt these AI capabilities more broadly across their operations?
GXO IQ is the platform, first and foremost, that allows faster rollout of AI to our operations to get the benefits rolling for our customers. You can imagine it as a warehouse management system in the way that we have positioned it. It interfaces with our warehouse management systems and is really agnostic to the warehouse management system platform that we're running in a particular operation. And it is effectively the store where our facility managers and teams can go and shop for the AI tools that can deliver value in their operation and create the greatest combination of AI tools to maximize the result. And so by deploying GXO IQ, we've made AI accessible to the operations on the warehouse floor. We're able to measure the impact and result and return on investment associated with the AI modules so that we can make the right improvements to those, have the impact of that hit the 1,200 sites that are out there, or maybe stop working with a tool that isn't delivering an expected return and position something that is more improved and can deliver a better result. It's integrated with our data lake, and that is a big part of how it derives its value, is being able to access a very large data lake associated with those operations that we run. And so for customers who come on board with GXO, as we start up for you, you're plugged into GXO IQ just as a process of being integrated with us, then it is really about making sure that we're driving the deployment of those AI tools and continue to drive continuous improvement in those AI tools going forward. So, as said, we've deployed to about 30 sites so far, with plans in place in 2026 to accelerate that deployment.
That's great. Patrick, it was nice to hear during the conference call that the long-awaited Wincanton integration is now officially underway after a little hiccup there with the CMA, and it's progressing well. So you've already mentioned your first joint customer win and remain on track to deliver the 60 million cost synergy run rate by the end of 2026, which is encouraging. Beyond that, there's also meaningful revenue synergy potential as you leverage combined customer relationships across Europe, particularly within the key industrial and aerospace and defense verticals. You have plenty of M&A experience under your belt, overseeing 4 transactions over the past year alone at DHL. With that context, what are your early impressions of Wincanton so far, and how do you view the strategic fit within the GXO platform? Then in terms of revenue synergies, looking back, it took roughly 18 months for those from the Clipper acquisition to begin materializing, ultimately helping to secure the landmark $2.5 billion NHS supply chain contract. What's your outlook for realizing similar cross-selling or vertical expansion opportunities as the Wincanton integration continues to progress?
The thing that comes to my mind on Wincanton is the great people that have joined the GXO from the Wincanton organization. I'm 4 or 5 months into GXO right now. One of the things that has struck me here as being really unique is the performance culture at GXO. I heard somebody recently refer to our team members as athletes, which is, I think, a perfect personification of the attitude that people come in to work with every day. And I see that in the Wincanton teams that are joining our GXO team. And I think we're really, really going to benefit from the contributions of those individuals. On the cost synergies, as you mentioned, we're on track for the 60 million run rate by the end of 2026. Very exciting is the revenue synergies that are emerging as a result of the marriage. Wincanton brought great expertise on especially the industrial and aerospace markets. We are taking their leadership on a few very significant opportunities that we're pursuing, both in aerospace and defense. And you can already see the quality of our solutions and the quality of our proposals improving with their leadership in that area. In the third quarter alone, we saw our aerospace pipeline increase 30% quarter on quarter. And that really came with being able to unlock the CMA restrictions and get the teams working together. And we're already seeing results in the pipeline of new opportunities from those revenue and solution synergies that we have. The average deal cycle time in the contract logistics industry is 6 to 9 months. So the conversion of that pipeline will come in the middle of 26, and we'll see that. But for me, I'm super excited about the revenue synergies that come here and how that can underpin our organic growth priority as we're moving forward into 2026 and going forward.
Sounds great. And the last one here, Patrick, I've heard you talk about the winning team at GXO. After your first 100 days or so, tell me what stands out about the people you have in place and the new people you hope to bring on in the future. You could break news here and tell us the name of your COO. You don't have to, but just generally speaking.
Yeah, I won't break news here. The announcement will be out shortly.
Okay.
That person is in process, and I am super excited. It's an industry veteran who has global experience and really going to bring a lot to our global agenda. As I mentioned at the beginning of the call, the culture of the GXO organization is what attracted me most. I use the term athlete. We refer to the folks within our organization as teammates. I think those are perfect personifications of the culture at GXO in terms of being performance-oriented, team-oriented, and goal-driven. And it was really fascinating for me coming in, because I think a lot of people say Yeah, it's a performance-oriented culture. Everybody wants to achieve results. But I saw very early underlying behaviors that I would attribute to high-performing teams. And the one that resonates the most with me is a feedback culture. And it was really fun going through the interview process with Brad Jacobs, as you can imagine. Great questions from him. And the end of the interview concluded with feedback. Here's what I thought you did well. Here's where I thought you could have done better. And I thought that was interesting. That sort of hit me in a different way, being in that setting. But then when I came in and started working in this environment, I saw that happening regularly in just meetings that people were having. If we were having a management review meeting, at the end of the meeting, there were people putting compliments out to the room, and there were people putting constructive criticism out to the room. And I think that is how teams become high performing and how you sustain high performance. And so the things that I've heard from the outside about the GXO culture, I've found to be real on the inside. And it makes me so excited in terms of the agility that we can move with, the speed in which we can work, and the opportunity to align the 150,000 teammates at GXO around a common vision and priorities of organic growth, margin expansion, delivering great service for our customers, and being a great place to work for our people is infectious. And I'm so excited to be here for that.
Well, Patrick, this has been really, really helpful to all the investors out there for sure. Before I bug your assistant to get me some of that beautiful GXO swag in the background, we see the bag, the coffee mug, the whole thing. Just want to encourage people to listen in to the quarterly conference calls. Go to the website, go to the investor relations, see all the documentation and the plan, because this is going to be a phenomenal story. And I think this is the quintessential AI beneficiary and robotics theme moving forward. All of these technologies applied in real time. GXO is ahead of the curve, and the good days are just beginning. So with that said, I want to thank the CEO, Patrick Kelleher. Thank you so much.
Thank you so much, Tom. I appreciate being here.
And we're back. Wasn't that incredible? Let's get on with the podcast. Here are the quote of the week from Ray Dalio. The biggest mistake investors make is to believe that what happened in the recent past is likely to persist. What happened in the recent past? Defensives and staples and healthcare didn't work. What's happening? They are turning the corner. Healthcare is one of the biggest performers since the last couple of months. That theme will persist and excel in 2026. Midterm election years are volatile. Defensives and healthcare and staples do best and dramatically outperform the S&P. You, speaking to my clients, are well, and you, the listeners who are not clients, are well positioned for it if you've been paying attention. Want to thank everyone who's been buying the merch, hedge fund tips. Look, we've been doing this for over 6 years for clients and non-clients alike. We've really been doing it for clients and allowing non-clients to listen in, many of whom have become clients, but some of you are never going to be able to become clients. I think if you learn the framework, you will be able to grow your account over $1 million and become a client. But either way, all we ask is if you're getting value and making money, please share the podcast with one or more of your friends who you care about this holiday season. As we continue to grow, we'll continue to do this for clients and non-clients alike. And go ahead and email to info@hedgefundtips.com a picture of you wearing the merch so we can add you to our Hall of Fame here. We got a few more this week. You can check it out and take advantage. Let's get down to the data. For the week, China internet versus U.S. internet software 12-month forward PE. They're just coming off the mat in China, despite the stocks being up 2 and 3x. We are super excited. This will persist in 2026 and beyond. Largest cumulative losses before a young startup companies turn to profit, compared with cash burn for OpenAI and Anthropic based on media reports. So we've never seen a cash burn like this between Anthropic and OpenAI. The last one we saw was Uber, and that actually worked. and Tesla looks tiny in comparison to what we're seeing with OpenAI. So it'll be interesting to see how that plays out, especially with Gemini 3 taking the lead and Quen, the Alibaba model, kicking butt. A lot of great stuff going on. Commodity 10-year rolling returns, highest since bonds versus bonds since 2008. We've been talking about the commodity opportunity. It's starting to play out. We're seeing it in our positions like Albemarle, like Comstock Resources, like National Oil Well, Varco. Super exciting times. AI adoption rates by corporate customers are slowing. We saw that with Oracle last night. We'll keep it PG. The bed on earnings. Don't buy the hype, ladies and gentlemen. The AI stories are going to be the GXOs of the world, not the hyperscalers at the same scale. They will be spending, we will be benefiting. Low expectations, consensus long-term growth forecast near a record low. Sell side analysts. That's always same with consumer sentiment, which is at a record low, which is why we had to get in another discretionary stock before year end with Papa John's. All my happy billionaire and centimillionaire and decabillionaire clients that got their Papa John's gift card are smiling so wide they could eat a banana sideways. Last year they got Vans, sneakers. This year they got Papa John's. We try to give them something from the portfolio each year and help earnings power. I had one smart aleck send me an email. I hope we initiate a position in Race, which is the ticker for Ferrari. So next year, my stocking is filled a little bit more fully. Just enjoy your pizza. We'll talk about Ferrari in 2026. Credit metrics are improving. European equities tracking toward best year versus the US since 2006. If you've been listening to this podcast, you were positioned for international and you crushed it this year, outperforming the US, having emerging markets, having ex-US. Share of hedge fund stock holdings in top quintile of beta. Natural gas prices soar amid LNG export boom. We love that Comstock. Lithium's recovery is only just starting, UBS says. I love UBS. I love all the pessimistic European banks. They're always pessimistic, and they always get it after the fact. They couldn't sell it hard enough when the stock was at $58. This is our Albemarle position. Now that it's at $130, they're saying it's just getting started after a double plus. Amen, hallelujah. Keep pitching it. So in another turn and we get to 3x and 3.5x and 4x, we can lay it off to all the people that you are getting excited at $200 a share. Indexed return of consumer discretionary versus S&P 500. This is what we're talking about, ladies and gentlemen, why we had to get some discretionary. Everyone's getting out. We be getting in, as they say in the neighborhood. So price changes for selective market classes. We're seeing car prices normalize. This was core to our Cooper standard thesis, which is now benefiting, looks like today, even today, up again, up around $32. Those of you who have been with us for some time, we initiated in May of 2022 and went live on the Clayman Countdown Fox Business. Our starting basis was $5.10. It's now at 32, going a lot higher. And small caps start to take off mid-month in December and tend to outperform through March. And we think that Cooper will benefit from that trend as well, in addition to incentives going up from the OEMs and affordability improving. Fed funds rate versus core PCE inflation tends to follow. Rates are coming down more. there was news yesterday that Trump is actually interviewing Warsh. That would be a mistake, in my opinion. Go with Hassett, go with Waller, go with Bowman. Don't go with Warsh. He has historically been a hawk, not a dove. He will say in his interview that he's a dove, and then he will turn into a hawk, not dissimilar to what we saw with Powell. Although Powell came out yesterday, and I think Powell wants to go out like Seinfeld. He was very balanced yesterday, did a good job, and he may, in fact, just pull off the soft landing if he gets another cut in before his exit, which is a coin flip. He can salvage a really good legacy. So kudos to him, and pat on the back if he pulls it off. Spread of 100-day trailing returns. That's growth minus the S&P. IGV. So that got smashed just in the last few months, all the Momo stocks. Trump is approving tiny cars to be built in America. You can be sure that Cooper Standard will provide tiny door sealing, fluid transfer, and systems for the cars, tiny, large, you name it, we got it. Cooper Standard is going up. Opinion, not advice. Go to hedgefundtips.com and click on terms. Consult your psychic before doing anything from this podcast or otherwise. Bottom up S&P earnings estimates continue to go up. Double-digit earnings growth for next year, 13%. That is good. Small cap half-month seasonality, as we can see, second half of December is the highest performance part of the year. That will help some of our smaller cap positions. The Goose, the Cooper Standard, the VF Corps. That's not quite a small cap. The Varcos, etc. So even Papa John's to a lesser extent. It's not a huge company. Here's consumer sentiment we've been talking about. This is why we had to get some discretionary and get some pizza on the plate in addition to our Vans and our North Face and our Timberland and our although Estee Lauder is not a discretionary, that is a staple. Women will give up lunch and dinner before they give up MAC foundation or Estee Lauder or Dr. Jart or all the other incredible brands that Estee Lauder owns. Short interest for the median S&P 500, NASDAQ 100, and Russell 2000 stocks. Russell's has the highest short interest. We are going to see squeezy over the next few months. We love that. Goldman Sachs equity sentiment indicator of investor positioning is just starting to turn upwards. Gas is set to power the bulk of new U.S. data centers. Go Comstock, it's your birthday. Zootopia 2 is now eyeing a 1.5 to 1.7 billion run rate at the worldwide box office. Oh, and by the way, AI beneficiary, not cost center. It only cost them $150 million to produce. AI beneficiaries versus AI cost centers all day long. The outlook for U.S. GDP growth has improved. Discretionary investors are implicitly pricing in a sharp slowing in earnings growth. Good luck with that, ladies and gentlemen, because if the Supreme Court votes against the tariffs, not only will Trump find a way to keep the tariffs going in the intermediate term, but in the short term, versus returning that money to the foreign countries, he will take that money and dividend it out as a check to U.S. taxpayers. And I'm going to tell you that the people who receive the $2,000 checks are going to be using it to buy Papa John's pizza and Vans. So that would be a great thing, not a bad thing. We'll see what happens on that front. But I have a sneaking suspicion between the increased tax refunds from the big, beautiful bill, fiscal impulse, and potentially dividend checks, discretionary is going to do A-OK in 2026, especially from where we're buying it. Rolling 1-year correlation between healthcare and NASDAQ, excess returns versus equal weight S&P 500. You can see this extreme, which is why we have the additional healthcare exposure with Pfizer, and we have it positioned in a unique way that clients will see in their accounts, so that even if the stock doesn't double over the next 3 years, we will make a multi-bagger for clients, which we love. More S&P firms are raising earnings guidance. Here is small cap ETF flows. Russell on the verge of a breakout. Want to be paying attention to this. Here is forward earnings per share. As you can see with tech and the hyperscalers, price has gotten well above earnings per share. And when you get these type of divergences, the price tends to back up, which is why we think indices are going to be subdued and volatile next year because of the dramatic weighting of the hyperscalers, even as the groups that have underperformed, defensives, staples, healthcare, are going to outperform dramatically, and lots of money will be made under the surface. It will not be seen in the indices, so the passive indexers will be disappointed. The overweight tech people will be excessively disappointed, and the followers of Hedge Fund Tips with Tom Hayes and clients at Great Hill Capital will be smiling so wide they could eat a banana sideways, just like they were smiling so wide they could eat 4 bananas sideways in 2025. Sector share of market cap, you can see IT at 34%. So if IT doesn't do well or consolidates the gains next year, the indices won't do well and consolidate the gains, but these other groups will start to pick up. The materials, you're already seeing what a preview of what's to come with Albemarle. REITs are going to start to outperform. Crown Castle, staples are going to start to outperform the Diageos, the Estee Lauders of the world. And then you're going to see international continue to outperform with the weaker dollar, aka Baba, Baidu, AtL, and then beneficiaries of a weaker dollar like GXO, who has tons of their earnings outside the US at present, will benefit from that weaker dollar as those earnings are repatriated. Annualized total outperformance by style during all bull markets since 1970. This is from Paulson. Small caps dramatically outperformed, then cyclicals, then global, etc. So positioning is key. Liquidity indicators, liquidity has come down. Guess what happened this week? Quantitative easing is back on. That was the beautiful surprise from Chairman Powell, who wants a positive legacy. They are going back into the market to buy on the short end of the curve and calling it something other than QE, but we all know what it is, and so did the market, which is why the Dow was up some 500 points yesterday. Number of $1 billion plus deals that are IPOs versus private deals. IPO is going to kick up in 2026. You're seeing SpaceX saying that they're going to go out at $1.5 trillion. You're seeing OpenAI saying that they want to go out. We'll see if they're in time. I'm sure they'll do okay because they'll control the supply and lay off a lot to retail, and so on. Market implied Fed path. Fed says 1 next year. Market says 2 or more. I think the market will be right. U.S. auto manufacturers at 52-week highs. Auto-related stocks are also rebounding. We love it. Monetary conditions for most of the economy are still tight. So we are in an easing cycle. Dividend payers are going to dramatically benefit. Just look out through history. And, that helps the Stanleys, that helps the Papa Johns, that helps the Pfizers, that helps the Hormels, dividend aristocrat paying for 60 plus years, and so on and so forth. So moving right along, Wall Street forecast for 2026. Bank of America is the least bullish, and Deutsche Bank, an European bank, is the most bullish. That is something you don't see every day. Consumer staples relative to S&P, all-time low. This is the time of your life to buy this. You haven't seen. By the way, this is how Warren Buffett had a few of his best years ever from 2000 to 2004 in terms of performance, when the NASDAQ crashed 90%, 80, 90%, names like Amazon, etc. While those were crashing, Buffett had record performance because he was buying all these staples that no one wanted in 2000. And then as tech rolled over, he made money like crazy. Similar things will be in the future. I don't think we're going to see massive crashes in tech at all, but I do think we're going to see outperformance of these defensives and dividend payers in 2026. During the dot-com bubble, stock prices clearly decoupled from fundamentals, a phenomenon yet to be seen recently, although we did see it a little bit in the earlier chart. Forecasts for U.S. electrical demand are accelerating. We love that. Generac backlog for the data center generators is $500 million and growing. Comstock Resources is going to power this move. S&P 500 performance during the presidential cycle. Worst year is the midterm year for indices. Average max drawdown is 17%. Average returns are low single digits. What outperforms by 9%? Healthcare, staples, defensives, dividend payers. Be prepared, amigos and amigas. Most of the Magnificent Seven are lagging the S&P 500 in 2025. You wouldn't see that in the headlines. What has been one of the top performing AI stocks is Intel. Has dramatically outperformed all AI stocks with the exclusion, I believe, of AMD, but that may no longer be the case, in which case Intel is the number one AI stock. And if you were watching Stuart Varney in September of 2024, when we were pounding the table, literally, he always makes fun of me for pounding his table on set at $18 and $19, you guys made coin, and you should buy a hat and tell your friends and family about this incredible podcast. All right, moving along. You can see ADP employment moving down. That's going to keep the Fed's pedal to the metal. M&A deals are picking up. There's still some animal spirits. Dow Industrials 4-year presidential cycle. We just finished this. We had that drawdown, some strength into year end early, and then weakness into the fall, recovery, and then 2027 is a rock your socks off. My guess is 2026 will be similar to 2022 in that we will be massive buyers of tech in the fall after everyone gets taken out behind the shed and shot. We will be picking up the remnants in the tech sector sometime in the fall of 2026 with all the money that we make from the healthcare defensives and dividend payers in the early part of the year. Here's the Ned Davis chart. If you are listening to this podcast, congratulations. Means you're probably exercising while you're doing it, multitasking. If you're getting value, there's no question you are. If you watch it one of these times, you're going to get 10x the value. It's the difference between listening to a basketball game and actually being on the court and watching and experiencing it. It's a completely different game, especially with all these data charts. Here we go. Retail clients were the biggest net sellers last week. Well, they missed the rally after the Fed. That's unfortunate. Every 1% savings in labor cost equals 2% upside in S&P 500 EPS. The productivity enhancements of the AIs and other tools coming to bear are going to increase margins for the beneficiaries, decrease margins for the cost centers like hyperscalers. Dow Jones transportation average versus the industrial average. A lot of opportunity in transports. I'm waiting on UPS to replace the CEO. I'm waiting. We have Boeing, which has been great off the April lows. We continue to love that stock. A lot to do in the transports. If you don't have any exposure, I think you could probably put GXO in that category. So we've got enough exposure there. Rule of 10 best days trying to time the market. Impact of not owning the 10 best days trying to time the market. You would have, since 1928, if you're in every day, you earn 8% per year, or 14% since 2016. If you miss the 10 best days of the year, you lost 13% per year, or 9% since 2016, which is no bueno. So buy great companies, sit on your hands, ignore the noise, avoid the shiny objects, and you will compound your wealth massively over time. Dollar touches the lowest since October after Fed cuts rates. Utilities versus the S&P, these will do well next year as well. That's part of defensive groups. Just stay away from the ones that have already had a bid due to the AI story and are overvalued. November 2025, a lot of launches, a lot of leverage launches. Those people are going to get taken out behind the woodshed and shot on the triple leverage stuff, and they're all in the triple leverage shiny object funds. They're toast. They're going to absolutely get roasted in 2026. US dollar is following its historical roadmap. Those of you who have been around with us for a few years, we were calling for that when no one else was. That trend is going to persist for a few more years. Here's the average year returns, average midterm year. As you can see, there you go. You got to be in the ones that benefit from charts like this. Oracle credit risk cost doubles since October, and they had bad earnings. S&P forward ratio, subsequent 10-year annualized return. So they're saying the PE ratio implies more subdued returns. I'm not sure that's going to be the case. I do think you're going to see the weighting of the hyperscalers start to reduce and some other groups pick up the baton to drive the overall indices through the end of the decade and early 2030s. Holiday spending update, 2025 is exceeding the previous years. We like to see that. December cut near all-time highs. Could have bulls smiling in 2026. It would imply low double-digit return. We'll see what happens on that front. Maybe after, the year-end rally after the election. Operating profit margins now at record highs. Small caps just breaking out. No one's paying attention. This is going to be the theme for the next 2 years. If you don't have small cap exposure, you are asleep at the wheel. Cumulative ETF flows by current cycle. What else do we have here? Professional investors lightened up ahead of the meeting yesterday. So sorry you missed it. Average annualized forward frequency, economic quint. Okay. All right. So that's that. Let's move on to some of the headlines of the week. Exclusive ByteDance, Alibaba keen to order NVIDIA H200 chips after Trump greenlight, sources say. Meta reported to use Alibaba's Qwen for avocado model in likely win for China. U.S. investors are going big on China AI despite concerns in Congress. That's Alibaba. The concerns in Congress are nonsense. At the end of the day, Trump is going to China in April. If he has some hiccups along the way where it's going to impact his handshake with Xi Jinping and his ability to declare victory, you'll have the Rick Scotts of the world come out and do the delisting bullshit again, and they'll be wrong. It's the only kind of arrow in their quiver when the Chinese are not cooperating. They threaten that, and then everything gets back to the table and they move forward. It's mutually assured destruction if they were ever to do that. So they won't, but they'll threaten it. They'll get to the table, and Xi will continue to slow walk for another 2 years and give as little as possible, and Trump will declare victory, and that's the way it's going to go. China Politburo makes boosting domestic demand top goal in 2026. Alibaba is the toll taker for China consumption. Expect more great things there. China, Hong Kong stocks set to gain nearly 20% in 2026. JP Morgan says. Opinion follows trends. These were the same group that was downgrading Alibaba in the hole at $60.58, calling it uninvestable. Now at 160, they're saying it's going higher, and they're actually going to be right this time. They were completely wrong last time, and when it's at 250, 300, and they're pounding the table, we will be laying off all of our shares. North Face skims to launch second winter wear collection. This was a sellout the first time they did it with Kim Kardashian, and we love that for VF Corp. The one thing people are still buying, beauty products. Go Estee Lauder, go Estee, it's your birthday. Luxury stocks set for revival in 2026 after roller coaster year. We love that. With our Estees, with our Canada Goose is loose, with some of the high-end collaborations for VF Corp and more. Lot of exciting stuff happening there. Boeing completes acquisition of Spiro to Arrow Systems, major supplier. I love that Airbus is now struggling and they're having mechanical problems. Boeing is soaring in a duopolistic environment. That's a good thing, not a bad thing. 777X order spree to widen lead over reeling Airbus. Amen, hallelujah. Albemarle jumps as UBS says it's time to buy on lithium recovery. Where were you at $58 when we were pounding the table on the podcast? Thank you so much, and we will be happy to lay some off to you after another turning the double into triple plus. Biggest natural gas quarterly spike in decades as deep freeze slams U.S. East. We love it. Music to our ears. Citadel's Apex said to buy U.S. gas assets from Comstock. They laid off $430 million to delever the balance sheet, pay down some debt. We love it. Smart timing after a run-up. Couldn't be happier. Investors turn to overhated and underweighted energy stocks. Go Varco. It's your birthday. Let's go. We love the servicers because they are less sensitive to the price of the underlying commodity, which we think, by the way, is probably due for a bounce. Stellantis CEO says hybrids are a top priority for the U.S. market. Why is that important? Cooper Standard makes more per vehicle, cost per vehicle on hybrids than they do ICEs. Our model is predicated on ICEs, which have the lowest cost per vehicle. So we're very, very conservative when we think that Cooper Standard can earn $10 a share at the top of the cycle 2 years out. You put a 10 or 20 times multiple, and that's where we think we can go, despite the six bagger already in the bag. Why home buyers see some hope in 2026. We agree. Disney making $1 billion investment in OpenAI will allow characters on Sora AI video generator. What could go wrong with Disney characters being able to be manipulated by anyone in any way they want? Time will tell, but I guess they'll be engaging with the brand. U.S. tech stocks may not be so exceptional in 2026. You already got tomorrow's newspaper yesterday, and therefore you are positioned and have benefited. Oracle shares tumble as AI spending outruns returns. Besant says U.S. will finish the year with 3% GDP growth, sees very strong holiday season. Treasuries gain as Fed cuts. Traders wager on 2 more in 2026. TLT will go higher. Fed Chair Jerome yields lower. Everyone's saying that the yield curve is going to steepen. I don't think so. I think it's going to surprise a lot of people that the 10-year is going to get dramatically bid in 2026 as volatility picks up. Fed end cuts happen. Fed Chair Jerome Powell says U.S. may be drastically overstating the jobs numbers. You keep believing that and keep cutting rates. We love it. Here's from my buddy Jose Torres over at Interactive Brokers, the senior economist, talking about the Fed cut. Fed central bank has seen its balance sheet shrink to a significant 2.43 trillion since its peak in April 2022, and now judges that reserves at financial institutions have dropped to ample levels, which justify acquisitions of T-bills to ease funding stress in the system. Usage of the Fed's repo facility has begun to trend much higher in recent months, an indication that banks have too much government debt on their books and not enough cash, a condition signaling the potential for scarce reserves in the near future against the backdrop of rising fiscal issuance and liabilities. The reversal from quantitative tightening to the addition of new fixed income instruments is kind of like QE and is music to the ears of stock bills as it bolsters liquidity conditions and adds fuel to the fire of some of the most speculative areas in equities. Indeed, folks, the small cap cyclically oriented Russell 2000 has reached a fresh all-time record for the second day in a row, and all the major domestic benchmarks are advancing on the session. Yield curve is plunging in bull steepening fashion, leading south by monetary policy sensitive front end, while today's accommodative tilt is sending commodities north due to stronger growth projections. Amen. Hallelujah. QE is back. Small cap stocks may be ready to outperform after 5 years of lagging. Amen, Jacob Sun and Shine over at Barron's. Hope you're doing well. Article of the week, holiday cards and auto parts. Holiday carts and auto parts, stock market and sentiment results. I think that's the best title that Jeff has done so far. Really good. I like the rhyming. Makes it easy to remember. Let's get down to advanced auto parts update. The AAP turnaround continues to gain traction, delivering its strongest quarterly performance in more than 2 years, with comp store sales up 3% and adjusted operating margins reaching 4.4%, up 368 basis points year on year. The new CEO, Shane O'Kelly, who took the helm just over 2 years ago, is proving to be exactly the caliber of leader this strong, struggling business needed after years of mismanagement and false starts. While the market remains blinded by recency bias surrounding AAP's seemingly never-ending multi-decade turnaround, and maybe because aftermarket auto parts aren't as sexy as AI, that lack of glamour is exactly what creates the opportunity. What will be sexy is the operating leverage that gets unlocked as store-level execution improves and supply chain efficiencies take hold, clearing the path for normalized earnings power that the market still refuses to give AAP credit for. Until then, we're happy to sit on our hands and wait as the turnaround unfolds. A few weeks ago, O'Kelly and CFO Ryan Grimsland gave an excellent high-level update on the turnaround's progress and fielded investor questions at the Gabelli Fund's 49th Annual Automotive Aftermarket Symposium. For anyone wanting to understand the key levers being pulled and why we have such strong conviction in this management team, the discussion is well worth the time. We're not going to play it here because we already had the 45-minute interview with Patrick Kelleher, but you should definitely listen. It's well worth a while. We've highlighted the key points in the earnings results as well as the conference call. You want to go to hedgefundtips.com and do that. But here are the 10 key points. Advance delivered $2.04 billion in revenue, down 5% year on year, beating consensus by $13 million, with the decline driven primarily by operating fewer stores after this year's footprint optimization that closed 700 underperforming locations. Adjusted earnings of 92 cents beat expectations by 18 cents and compared to a loss of 5 cents in the same period last year. 2. Comparable same-store sales grew 3% for the quarter, landing at the high end of management's low single-digit guidance and accelerating from last quarter's 10 basis points positive contributions from both the Pro and DIY channels. 3, the Pro channel delivered just over 4% comp growth in Q3, making it its 5th straight quarter of positive performance on a 2-year basis. Trends remain positive in Q4 so far, with the new strategy gaining traction as store availability has improved to 96 to 97% from the prior low 90% range, and time to serve has fallen by more than 10 minutes. The Main Street customer group, the highest margin segment within Pro, still represents the single largest opportunity. 4, the DIY channel delivered positive low single-digit comps during the quarter, showing sequential improvement in transactions on both a 1-year and 2-year basis. Moving into Q4, management has seen more pressure on the consumer and some volatility in week-to-week transactions, but remains confident in the long-term outlook, given the non-discretionary nature of the business, with 90% of sales tied to repair and maintenance. Remember, the average car is 14 years old now. 5, the market hub strategy continued to progress, with management now expecting to open 14 new market hubs this year compared to their prior expectations of only 10. They're still targeting 60 market hubs by mid-2027 and expect to end the year at 33. These hubs carry 75 to 80,000 SKUs and provide same-day parts availability to a service area of 60 to 90 stores, which has driven a 100 basis point comp sales uplift to supported locations so far and creates incremental opportunities to gain market share. In addition, management expects to have 16 distribution centers by year end compared to 38 just 2 years ago, as well as open 30 new stores for the full year and still target at least 100 new openings over the next 2 years. 30 new stores and 100 new openings over the next 2 years. That is not a company in decline. That is a company that cleaned up a mess and is now back in growth mode, expansion mode. 6, Advance has invested $50 million in store upgrades year to date, which include improved HVAC systems, roofing, parking lot signage, and is more than double the total CapEx allocated to these projects last year. These upgrades cover more than 1,400 store locations year to date compared to just 440 in 2024. Management expects CapEx to total $250 million for the year, lower than the prior $300 guidance due to timing shift into 2026. 7, adjusted gross margins came in at 44.8% for the quarter, up 260 basis points from last year's 42.3. Adjusted operating margins, the most important metric in the AAP turnaround, came in at 4.4%, up 368 basis points year on year, and the strongest quarterly performance in more than 2 years. Management remains confident in the 2027 target of 7% adjusted operating margins, with street consensus still forecasting just 4.8% for 2027, a number we expect to move higher as it becomes obvious. 8, year-to-date free cash flow stands at an outflow of $277 million, which includes $130 million of cash charges related to restructuring activities. Management expects full-year free cash flow to be an outflow of $80 and $90 million and includes $150 million of cash charges. Backing these out, AAP would have delivered positive free cash flow for the year, giving management confidence in the ability to generate positive free cash flow in 2026 and beyond. 9, management narrowed and reaffirmed the midpoint of full year guidance, now expecting net sales at 8.55 to 8.6 billion compared to 8.4 to 8.6, which implies an upgrade of $750 million in sales. Comp sales growth is expected to be 0.7% to 1.3%, and adjusted operating margin is projected to be between 2.4 and 2.6%, which implies more than 200 basis points of annual margin expansion in the first year of the turnaround plan. And 10, management views First Brands as a one-off situation rather than a broader concern for the aftermarket industry. AAP currently sources less than 2% of cost of goods from the supplier, with plenty of alternative options among the hundreds of vendors they already work with. Management recorded a non-cash charge of $28 million in cost of sales during the quarter to account for future credit losses on receivables from First Brands, and this will not affect full-year guidance. Earnings call highlights are highlighted. Go to hedgefundtips.com. While you're there, click on terms, opinion, not advice. Moving on to Etsy update. As we can see, free cash flow is near all-time highs. Revenues are at all-time highs. Gross margins are at or near all-time highs. Price to free cash flow multiple at or near all-time lows. And you can't give the stock away. We think that will change. And here is why. Here are the 10 key points from the most recent earnings call. Etsy delivered Q3 revenue of $678 million, up 6.1%. year on year, and ahead of Wall Street consensus by $21 million, driven by a 12.7% increase in seller services revenue to $210 million, while marketplace revenue declined 1.7% year on year to $468 million. Etsy's take rate of 24.9% came in ahead of guidance, expanding 220 basis points year on year and 90 basis points sequentially. 2, consolidated GMS came in at $2.72 billion, up 0.9% year on year, and above the top end of management's prior $2.6 to $2.7 billion guidance range. Etsy's marketplace GMS totaled $2.43 billion, ahead of expectations and down 2.4% year on year, but improving by 300 basis points sequentially. GMS per active buyer on a trailing 12-month basis was 121, down 1.6 year on year, but improving sequentially and continuing to show signs of stabilization. 3, Depop continues to be a bright spot with gross merchandise sales of 992 million. I'm sorry. Gross merchandise sales of 292.1 million, up 39.4% year on year, a 400 basis points acceleration from last quarter, driven by 59% gross merchandise sales growth in the US. Depop active sellers climbed 40.8% year on year to 3 million, and active buyers rose to 38.8% to 6.6 million. Depop is now tracking toward annualized run rate of $1 billion plus, and management continues to see significant opportunity to scale it into a multi-billion-dollar asset, launching the brand's first ever campaign during the quarter to further raise U.S. awareness. 4, earlier in the quarter, Etsy signed a partnership with OpenAI to become the first live partner within ChatGPT's instant checkout. This gives Etsy an early foothold in the fast-growing agentic commerce channel, with initial results looking promising. Early data suggests these buyers have higher purchase intent than traditional search, driving higher conversion rates and a noticeable spike in purchases from this traffic, albeit off a small base. 5, Etsy's app now accounts for 46% of total gross merchandise sales, up from 42.8% last year, with app-based GMS growing 5% year on year and outperforming non-app GMS by 13 percentage points. The app continues to drive higher engagement and purchase frequency, with app users generating 5x more visits, viewing 3x more pages per visit, and being 1.5x more likely to convert. 6, consolidated adjusted EBITDA margins came in at 25.4% for the quarter, in line with management's prior 25% guidance, but below last year's 27.7%. The margin pressure is primarily tied to increased marketing investment at Depop, while the Etsy marketplace continues to post margins just shy of 30%. Consolidated marketing spend increased 6% year on year to $208 million, or 30.7% of revenue, and is expected to remain elevated into the first half of 2026. 7, management repurchased 2.1 million shares during the quarter for a total of $120 million at an average price of $57.14. Over the past 3 years, Etsy has reduced its share count by 21.5%. through $2.47 billion in buybacks, making our slice of the pie that much bigger without putting up any additional capital. The current repurchase program still has $356 million remaining, 6.6% of the total market cap, leaving plenty of dry powder for continued buybacks, supported by $1.6 billion of cash on the balance sheet. Look at these repurchases. It's through the roof, and shares outstanding down 21%. 8, Etsy announced that longtime CEO Josh Silverman will step down after more than 8 years and transition to executive chair through the end of 2026. Kruti Patel Goyal will assume the CEO role at the start of 2026. She has been with Etsy for more than 15 years, spent 2 years as Depop CEO, where all the growth is, where GMS and the buyer base nearly doubled, and most recently served as Etsy's president and chief growth officer. 9, Etsy generated $205 million in free cash flow during the quarter, bringing trailing 12 months free cash flow to $635 million, 12% of market cap, and converting 83% of adjusted EBITDA into free cash flow. And 10, management guided Q4 GMS to $3.5 to $3.65 billion, with the midpoint implying further sequential improvement in the combined Etsy marketplace and Depop year-on-year growth rate. Despite an uncertain consumer backdrop, the Q4 take rate is expected to be 24.5%, with adjusted EBITDA margins under pressure at 24%, driven primarily by the significant sequential increase in Depop brand marketing during the holiday season. Here is the earnings call. We've highlighted the key important parts. You can find it at hedgefundtips.com. And finally, market fear and greed at 31. Still a lot of fear as the market breaks to new highs, and active managers starting to get exposure. Technology earnings estimates and revisions up 3% in the 3.5% in the last 60 days, and communication services down 1.18%, led by Meta. Economic data, the name of the game was the Fed cut this week. The rest is noise. You can see initial jobless claims came in higher than expected today, so it shows the Fed is on track for more cuts. Earnings growth for 2026, as we can see, continues to go up, now at 309, up from 305. So that's a positive. And now we will get to our favorite section of the week, which is the Ask Me Anything question. Questions from our incredible audience. If you have questions, go to hedgefundtips.com, click on contact, put in your question here, and just click on that. This contact is about AMA question for the podcast. Type it and submit. And we look at those once a week to get ready for the podcast. So, Marcel Bala, thank you for your wonderful work you're doing and sharing. I've recommended your podcast to 2 colleagues recently. Thank you very much. My question is, what's your opinion on Lanxess? It's a German chemicals company. All right. Lanxess. Okay, let's take a look. Revenues and free cash flow are headed in the wrong direction, hence the stock. Margins are starting to improve. Looks like the business has been deteriorating for a while. Let's take a look at financial analysis here. Find me some balance sheet, maybe. There we go. Let's take a look at that first. See if you've got enough time to wait out any turnaround. On this name, you're going to have to find out what's the management's plan to turn it around, because, see, so they got 400 million of cash, $500 million of receivables. Debt is 2.8, probably okay. Free cash flow is 135. Let's take a look at income. Take a look at quarterly, see what's happening there. Seems like it's trying to recover a little bit. Kept the share count pretty steady. Look, I think it's worth doing some more work on. It wouldn't be my first choice in the chemicals area, but I think you're onto something. So go listen to the last 8 calls, understand the turnaround plan. What did they say they were going to do? What have they done? What's the catalyst for change? And I think you might have something there. Eric C., I do not know how people complain about your podcast being long. Most don't. The losers do, but it is what it is. I believe they are too short. I have started listening to the same episode multiple times a week. What's your opinion on General Mills? Obviously, you've been listening because you are picking defensives for 2026 and you're going to make money. Congratulations. By the way, I always tell people, first off, the podcast itself is only an hour. It's the AMA. I take the time to answer the client question, the client and listener questions. That takes another hour. So you could just listen to the podcast part number 1. And I say, just listen. You know, if 2 hours is too long, just listen to 10% and you'll get 10% of the value. What else do you want to tell me? You know, I'm going to give the value where people want it. And but as far as General Mills goes, let's go here. GIS. You know, there was a story in the Bible complaining on the way to the promised land. Trip canceled, okay? God could only take so much. Complaining on the way to the promised land. Just cancel the trip. All right, let's see. So revenues and free cash flow have been under pressure. The stock is down about 50%. I think you're got no problems here buying this. Let's see here. Yeah. Subdued multiple, dividend yield. I mean, this strikes it on all fronts. I don't think you're going to get hurt with this. So go for it. I look, if you can get it at $40, great. But 45, buy some now, buy some more at 40, and then just hang on to it for a few years. I think you're going to be fine. I love it, Eric. And you're making money because you're listening to the whole thing. All right, so here's KD talking about please put race in the portfolio next year so you can send me a Ferrari instead of a pizza gift card. He's asking about 529 programs. Anything that you can do that's tax sheltered, you always want to maximize. So the answer is yes. River Ra. Love the podcast. Share it with everyone. Oh, listen, I love it. Check out WFG. It's a housing play. WFG. WFG. Timber Company. Yeah, someone else sent another one of those in. These are hard to value. But I think you guys are both onto something. Yeah, I think the other one, we're going to cover another one that I like better, by the way. I don't love this one yet. I think you're getting close. There's another one that I think is going to come up in the questions that you're going to like. Mills have been closing, volumes returned, beneficiary due to ample liquidity, reminds me of Albemarle. I think you're right. You could buy it here. I think there's a better play, and I just forget the name off the top of my head. What do you think of this? Is from Veronica Winters. What do you think of AMCR? Amcor. Yeah, this has been a compounder. I like it. We're not going to make a double on this, and that's kind of a requirement for us to commit any capital, but I think you're going to make money over time. This has been a long-term compounder. Let's just make sure it still is. Yeah, I think you're generally okay on this, Veronica. Do some work on it, listen to the calls, but I like it. Gleb Sitikov. Tom, I love the on-point call for a healthy dip in November. Just wondering, what are your thoughts on Zoetis? I hate the animal stuff because it just never works. It works on paper, and the stocks tend to not work. I don't know why. So instead of getting horse pills, get pills for humans who look like horses that start with a G and end up with a P, and I think you'll be much better off than Zoetis. Moving along. York Bourgeois, hope you've been doing well. Blah, 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 blah. How did you predict that the 10-year yield would stay below 5 and you were calling for a 3 handle? How'd you have that? We covered that on the commitments of traders data. Everyone was positioned on one side of the boat. And that's that. Fixed income, blah, blah, blah. Yeah, York, go to the Hedge Fund Tips channel, put in University of Bristol. I spent 2 hours with some students there, explaining to them what they should do in your shoes. I think you'll get value. It's not another week without a question about Fiserv from Ken W. It's probably time to buy some of this. I'm not going to, but I'd like PayPal. But let's take a look at this thing. Financial analysis. All right, Fiserv. Things trading like it's going out of business. Doesn't seem like it is, though. $27 billion of debt. So that's what people are worried about. Let's see what the free cash flow is. 7 billion. No, that's not free cash flow. 4.6 billion. Income statement. I think you can do it. I mean, it's not going to be a position for us, but I think you're okay there. Lucy J. Asking about Generac. I think they're being conservative, not the other way around. Felipe Andrew Pincos. Okay, he's talking about the patent cliff, which we talked about, offset by the new pipeline, offset by the new acquisitions, offset by the current valuation relative to history. etc. So this is a no-brainer. We love Pfizer. We positioned it in a way for clients that is unconventional so that they can make a multi-bagger off a very small move in the stock over the next 2 or 3 years. But it will go up nonetheless in our view. Jose Cuervo, are you concerned about Diageo's debt? No. So Diageo, this is a premiumization story. By the way, you always get these stupid questions when the stock is down on the day. It obviously came in yesterday when the stock was down. But let's just answer the question. And so Diageo is generating $2.7 billion of free cash flow. There's certainly some leverage. It's a valid concern, but this is one of the best in class, and it will benefit from people drinking less and drinking better. So here is the free cash flow, $2.7 billion, steady as she goes. Balance sheet, $2.6 billion, $3.7 billion in receivables, and long-term debt at 21. We understand the cap table. We understand how much cash they generate. We understand the value of the brands. They could always sell off 1 or 2 brands if they had to. They won't have to, but they might do it to benefit. And we also like to see, this is kind of amazing when you think about it, because drinking was at its peak in 2022 during COVID, and the revenues are still holding in there. And let's take a look at a quarterly basis. Reaccelerating dramatic. Well, hold on for a second. Reasonably solid there. And then let's take a look here. Share count been going down. We like this. Look, you got to have a play in the alcohol business. It's a massive overshoot. People still drink. They're going to drink. I don't want the mass market stuff, because people that are overweight probably drink a ton of beer and the cheaper stuff. And now that they're on GLPs, they're drinking less. But the high-end premiumization, they're going to drink less. They're going to drink better. Diageo is perfectly positioned. It was mismanaged. Now they have an adult in the room. We love this story, and we're sticking to it. Jose. Tim D. Oh, of course, yesterday we got 2 questions on Diageo because the stock was down. Lucas Tengrove. What do you think of Hunts? H-U-N. That's Huntsman's company. Chemicals. I think I like it. Let me just take a quick look and confirm that. Yeah, I've looked at this one and I do like it. I think a lot of opportunity in the chemical companies. Okay, there we go. That family will turn it around. They know how to run the business. Look, there's no imminent sign of a turnaround, so I would definitely get on the calls before you do anything, but they will fix it when the cycle turns. They have the operating leverage. I think it's a good company run by a good group, and you're going to make some money off of that for sure. Let's just make sure that the balance sheet is not going to smoke you in the meantime, and the answer is no. They've paid down a bunch of debt, and they still are generating ample free cash flow. So like that one. Good job, Lucas. On to the next. Matthew Tumbo. How do you approach tax loss harvesting? This is tax loss harvesting is for gamblers that think they can time the market. We covered if you're out the best 10 days. And oftentimes you sell in the first 2 weeks of December to tax loss harvest when everyone else is selling. And what happens to all those losers is they get bid huge at the end of December and the first 2 weeks of January, which you can't replace inside of the 30 days for wash sale rules. So bottom line is, if you're a gambler and like, oh, my trading thing went wrong and therefore I'm going to take my losses and like try to pretend that it's a win because you screwed up, have at it. But if you're owning a piece of the business and you're going to gamble that you can get out for 30 days, take the tax benefit, and get back in 30 days from now, I mean, good luck with that nonsense. At the end of the day, own the business and sell it when it's fully valued and call it a day. Like, I know that your typical financial advisor is going to say, this is the value add we provide. We're going to harvest all your losses. How about not having massive losses? Why don't you try that? My suggestion is don't have a ton of losses. And if you have a company that's taking longer to realize full value, just sit on your hands and wait. Stop trying to be so cute about everything all the time to save a few pennies on taxes. Every time I've ever waited till January to take the taxes into the next year or done tax loss harvesting, it always backfires. Either the stock tanks because everyone was doing it, waiting till January 1st to sell the big winner, or I sell it in the hole in December and it runs away by mid-January and I miss 10, 15% of the move. It's never worth it. If you're underwriting these businesses properly, if you're trading and gambling, yeah, take all your losses. I'm sure you have plenty of them. Alex Trickhoud just discovered the podcast a few weeks ago, already a big fan. I love that. Added your pod to a weekly finance call with a friend to discuss and learn from. Curious about your take on DGXX. Digipower Inc. Well, welcome. You are probably early in the learning curve. I would go back and listen to a bunch of other episodes so you can start to learn the framework a little bit better. But this is still negative free cash flow. We're not interested in those type of businesses, but appreciate you sending it. Yeah, this is data center. This is short-term shiny object stuff. It might work, but it's gambling, and we don't do that here. So keep listening in. You're going to learn a ton. And then if you still want to play these spec plays, shiny object theme plays, flavor of the month, Wall Street fashion show stuff, you can do that with a small amount of your gambling money. But the investing money, buying pieces of great businesses at good businesses at great prices. That's what we do. Good businesses at great prices versus great businesses at good prices. When Buffett had his greatest performance of his career when he was running the partnerships, he bought good businesses at great prices. When he had free float from the insurance companies and a permanent capital vehicle, he started buying great businesses at good prices because he had a lot more money to put to work, but the performance suffered over the long term relative to when he was buying good businesses at great prices. So on the one hand, Charlie, quote unquote, educated him. On the other hand, Charlie led to his underperformance, but also the law of large numbers impacted that as well. Paul Smith. I got that. Thank you for that. Cameron Hector. I love your take on buy now, pay later. Yeah, look, Cameron, let's see. Source of potential consumer leverage, analogous on a smaller mortgage buildup. Okay, it's not going to get anywhere near the mortgage build up, but it is going to get flushed at some point. So how's your view shape the way you think about consumer discretionary stocks that lean on buy now, pay later? PayPal specifically, I've been a listener since the COVID lows. You've helped my account significantly and made investing feel both fun and peaceful at the same time. Thank you, Cameron. Well, Cameron, you are a long-time listener, first-time caller. Thank you for being around that long. Glad your account is up big. I hate buy now, pay later. I think it's a crappy product that works until it doesn't. And it's small enough in the scheme of PayPal that it will be beneficial in the long term. They did a good job of selling off a lot of their portfolio. So I hope they continue to initiate it and sell it off to suckers, because sooner or later the chickens come home to roost. It's a low quality business, but it's high growth when it works and it's high margin when it works. Just lay it off like all the smart people did during the housing crisis, is they would originate and lay off to suckers. And hopefully PayPal will do the same as they have been so far. Adam Fies, question on PayPal. Same thing. I can tell you that I can look at a chart of PayPal and Diageo, and if it was red that day, we'll have 3 AMAs on PayPal and Diageo. And it's perfect metaphor for the psychology of an investor looking at day-to-day ticks. Why would your view of a stock or a company ownership change just because it is a red tick on that day versus when it's a green tick? If the stock shot up to $80, we'd have no questions on PayPal, and we'll have even less questions when it shoots to 150, and these poor folks had sold it at 61. Joseph Obertilk, longtime listener, and I share the podcast with everyone I can. Thank you very much. Thanks for the amazing content. Genuinely look forward to your videos each week. Booz Allen Hamilton. This is a consulting play. I don't really like these businesses. I think they're at further concern with the advent of AI. A lot of this stuff can be done without them. This is a broken Momo stock. And, if I owned it, would I be selling here? Probably not. But would I be encouraged to be a buyer here? The answer is no. Tom F. Bloomin' Brands. Turnaround. Yeah, I looked at this one. We ultimately passed on it for Papa John's. But I think you'll probably be okay here. Let me just try to understand. Let me take a look at the balance sheet. I think the whole group is going to be good in 2026, which is counterintuitive. Annual. So I got 100 million of free cash flow. Share counts come down. Balance sheet. That's your issue. 250 million. And then they've got how much debt? Well, they paid down the debt a little bit. I think it's a levered play. I think the other aspect was, I just think their product is shit. Let's see. Bloomin' Brands. No, Bonefish Grill. Yeah, I think you're okay. I think you're okay here. I kind of like this one. It was just a little too risky for me, but when the group works, you'll probably have a 3-bagger and I'll have a 2-bagger. So you may win on this, but you have a lot more risk than I do at Papa John's. So there's that. Charlie Baker. Christmas coming soon. Ben's best Christmas wishes. Hope all your wishes come true. You're a saint for many people. Thank you. Evaluate UHT, Universal Health Realty Income Trust. Yeah, I hate the medical property REITs because they always seem to screw up something. I just avoid them. I'm telling you, if you're going to have negative surprises in the REIT space, it's always going to be in the medical property REITs. I just avoid them as a rule. I would suggest you do the same. And, the difference between you and me is when God was handing out FOMO genes, he didn't give it to me. So if UHT doubles over the next 6 months, I don't give a shit. Like, it doesn't bother me in one way whatsoever that I missed it, because the downs, number one is rule number one, don't lose money. Rule number two, don't forget rule number one. And these medical properties, they always figure out a way to screw it up. So Bill C, ETF PSCH. We don't do a lot on ETFs. PSCH. Small cap healthcare. Yeah, why not? I'd rather pick companies. Noah L. Big fan of the podcast. Share it with my family and friends. Thank you very much. I know you already picked out Pfizer. Was wondering you could look at AKBA. I'll bet there's a lot of dilution in this stock without even looking at it. It's a biotech. We don't do individual biotechs. Our biotech basket has been a home run, by the way. Still free cash flow negative. Let me just see how piggy this management has been. Yeah, there's a place in hell reserved for management that does this to their owners. So they've increased the share count from 118 million to 245. No, thank you. On to the next. Matt J. Okay, Matt says, been watching for over 5 years and haven't missed even 1 minute. Until this week, I was not sure whether your ever increasing use of frank speech and slightly stronger language was improving the content. But then you said, quote, I wish PayPal would go to 49 so we could get all the whiny little bitches out of this stock, end quote. This week is in the most sincere of tones, and that this did it for me. Amen. Preach, brother. Thank you for continuing to tell it like it is, sharing your expert insight and strong reactions in whatever language works best. This is what makes the pod great. Thank you for continuing to put out this exceptional content from the heart. Happy holidays to you and your family, Matt J. Thanks, my man. I appreciate that. Yeah, we'll call this one PG-13. All right, Brent Lamborn. He's asking about Webull because they're changing the day trader rule to 2,000 instead of 25,000, so more people can gamble away the little money they have. Webull. Yeah, not for me. I don't like him. No. Chris, it's like benefiting from people doing heroin. It's like not for me. Chris Williamson. I said the guy who owns Diageo, but okay, I understand the hypocrisy. Can you do a brief look at Marqeta, ticker MQ? Okay, MQ. Cloud-based open API platform for card issuing. Yeah, the problem is it does look okay, but what is their moat? It's crowded. I'd just rather play a surer thing, which is the case with PayPal if I'm going to be in the space at all. They have scale. They have cash flow. Let me just see what's going on here. Look at this stock compensation. What a bunch of animals. All right. And the share count, increase the share count from 100 million to 500 million. Even if their business works, they're going to F you. So dump it on their heads, let them have it themselves and dilute themselves till the cows come home. Giant Patel, listening for 6 months. Got to know about you from your interview in Cooper Standard website. What are your thoughts on Crocs? I don't like Crocs. I don't even know why they exist other than for chefs and swimmers. Not for me. Hard pass. Buy Nike. If you're not going to buy VF Corp, buy Nike. Jigar Kapadia. Listening to your podcast for more than a year. Thank you very much. HelloFresh. HFG. Is that Hello Group? Let's see. HFG. I don't know. Those revenues are not showing any signs of recovering yet. Meal kit provider. No, forget that stuff. That's COVID. Skip it. Matthias. Hambuck. Whirlpool. We keep looking at Whirlpool. It's a play on rates in the housing market, so probably, but we've not seen any signs of turning the corner yet. I mean, revenues have just collapsed. I mean, the numbers are so bad on this stock that like I almost think that their product has gone to crap. But let me just see here. Cash. Cash flow annual. Free cash flow has deteriorated quite a bit. I mean, they're not really showing signs of turning the corner, but I think it's going to work. I kind of like it. I just wouldn't do it for clients because I would listen to the last 8 calls, see if they're got any plans to turn around, and as far as what you're saying about I don't buy things on the basis of someone else buying them. I buy it on the basis of me wanting to own the whole business. The filters being, if JP Morgan was going to finance me to buy the entire business, I'd have to be 100% of my net worth is the equity slug. So if it worked, I made 20x. If it didn't work, I went to apply for a job at Walmart greeter. I wouldn't do that with this stock. I wouldn't put 100% of my net worth into it, but I do think it's going to work, and I like the pick, and I'm bullish on rates and housing in terms of home builders and that whole game coming back on. But we're going to benefit on it through Generac and Stanley Black & Decker and some others that we can sleep like a baby. Molina, we haven't done anything because of the Medicaid risk, but it's probably going to work as well. But it's not for us. That's from Lachlan Neo and Seth, new client. And that's it. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.